I'm Andy Agafangelo, the founder of the Transparency Task Force. The Transparency Task Force is a UK-based certified social enterprise. We have approximately 4,500 to 5,000 people who get our weekly newsletter, The Transparency Times, and those people are spread around the world in 21 countries. But most of our focus, of course, is the UK. It's fair to say that when I started the Transparency Task Force back in 2015, I genuinely believed that the financial regulatory framework was a great big part of the solution to the problems I was seeing in the financial industry. However, over the years, my view has changed quite considerably. It's fair to say now that, to be frank with you and to be very, very candid, I now see the regulation of the financial sector as a big part of the problem. Not only is the sector not being very well regulated, the regulations we have are not being properly enforced. And whilst I genuinely hope I don't sound like I'm being too cynical too quickly, the harsh reality is that I believe the financial industry is riddled with all kinds of conflicts of interest. There's a particular problem around the revolving door issue. There's issues around regulatory capture, so on and so forth. And some of you will be very familiar with this book, a book that's recently been published called Rigged, written by Andrew Verity, the BBC's economics correspondent. The reason I'm mentioning the book called Rigged by Andy Verity is because that book, without any doubt at all, has put on the table very firmly the idea that there can sometimes be collusion, corruption, and cover-up between governments, particularly the Treasury, the banks, and the regulators. Now, it's not just Andy Agafangelo saying that. My opinion, frankly, doesn't really matter. But it is the growing opinion of more and more people. And when the BBC's economics correspondent, Andy Verity, who's a very, very well-respected journalist, spends a great deal of time writing a phenomenal fact-based and evidence-based book, where the central narrative is that there has been collusion, corruption, and cover-up involving the banks, the Treasury, and the regulators, then I think that gives me license, folks, to say we should really be taking this sort of stuff very, very seriously. Those of you who are familiar with the TTF will know that over the last few months, we've run several events about a scandal. We call it the Ulster Bank scandal. It's Ulster Bank, RBS, and NatWest. It's horrific. It's absolutely egregious, the things that are now coming out into the open. And that process of getting things to come out in the open is something that we really do have many, many journalists to be thankful for, particularly James Hurley at the Times, who just a few weeks ago wrote some absolutely superb articles about the issues we're going to be talking about tonight. Today's conversation is going to take us into the, if you like, the technical nitty-gritty around the issues, around swaps, interest rate hedging products. And effectively, we're posing the question, has it been fraud? And my personal opinion is the simple answer to that is yes. And of course, everybody can make up their own views about that for themselves. It'd be fascinating to see what you folks think about that question as we go through the conversation. Please do this for me, folks. Please make sure that the name on your Zoom profile correctly reflects who you actually are. It's not your mums or your dads or your sons or your daughters or your cousins. Make sure it's you. And please do make sure you're on mute so that we can minimize any background noise. I'll just repeat a couple of the housekeeping points because it's very, very important. The session is being recorded. Make sure you mean what you say and say what you mean. We will try to make it as engaging and participative as possible. And also, please, folks, make sure that you put into the chat things that you're happy to be circulated, because we will be circulating it all in due course. Okay, I hope that's all crystal clear. I'm now going to be passing over to Mr. Ian Tyler, who I believe is going to be sharing some slides and taking us through what I hope is going to be a remarkably interesting tour through some of the technical and regulatory issues around this whole question about swaps, mis-selling or outright fraud. Ian, over to you, please. Thank you very much. Thank you.
Before I dive into my presentation, maybe I'll just spend a minute just setting the structure for the evening, just so that people have a sense of what is going to come down the Zoom. So, I mean, firstly, I am going to do a short presentation on the subject of prudential regulation that relates to derivatives. I think it's very important to understand that there are effectively two very different sets of regulations that apply to derivatives. We spend most of our time, and Steve will be the second speaker, and he will speak to this. We spend most of our time focusing on the conduct rules, which are like in MiFID, where MiFID sets out this is how a bank should go around selling a derivative. And Steve will take us through that in the second part of this evening. But before we go into the conduct rules, I thought it would be really useful to look at the prudential rules. These are the rules that banks have to apply to, because they have to basically, under bank regulation, they have to measure all the material risks they have, and for the risks they have to hold capital. So that's what, when we use the word prudential, that's what we're saying. We're saying banks, you're highly leveraged institutions, you carry a lot of risks, you need to be very good at measuring risk, and for every risk you hold, you have to hold capital and liquidity to support that. And that's what prudential regulation is. And then after those two, what I hope will be very informative and get people up to speed, we will then look briefly at the example of Angelic Interiors, which is an SME company that was missold some derivatives. So we'll just use it as an example. And then, because I don't think this will be an incredibly long evening, I hope we can then have time for people to ask questions and actually have the opportunity perhaps to have some questions you've got on this subject answered. So that sets out the structure for the evening. In terms of sharing my screen, I now need to go and find it, but bear with me a moment. And share screen. So yeah, this evening I was going to spend, I don't know, 10 minutes, maybe 15 at the most, setting out some rules around how regulators look for banks to capture the risks around OTC derivatives. And what's really interesting, actually, and I had to learn this because I hadn't actually gone back as far as this, was actually counterparty credit risk, which is what we're really talking about, actually relating to derivatives, first actually made an appearance in the first ever multinational regulation that was formed back in 1988, when, believe it or not, I was a young man, and we used to call Basel Basel in those days. And the gentleman that led the original work was an old Bank of England guy called Mr. Cook. So it was known as the Cook Report, the Basel Accord, and these rules were put in place. And this was the first time that the major economies of the world had tried to create a level playing field for international banks. Actually, interestingly, the driver behind that was mainly a fear of the Japanese banks. Actually, the Americans and Brits were very scared about Japanese banks back in the 1980s. But anyhow, these rules were put in place. It's quite interesting. Derivative volumes were quite small in those days, in the late 1980s, but counterparty credit risk relating to derivatives was identified even as early as that. And effectively, back in those days, there were only two simple approaches allowed to calculating the exposure. And they were simple approaches back in 1988. The two methods were something called the original exposure method, and the other method was the current exposure method. And there was actually quite a healthy debate between the major central banks as to which was the more correct approach. I personally believe that the current exposure method was the better of the two. It's more intuitive. It comprises the sum of the replacement cost for the derivative plus an add-on for potential future exposure. And what that means is if you've got a derivative today and say it's out of the money from your perspective, in the money from the bank's perspective, they're worried if you were to go bust. So effectively they're like lending you money. So that's the amount that that's the current replacement cost. That's the current value of that derivative. But they also have to add on an amount for the fact that interest rates could change tomorrow and the amount you owe goes up. Now, back in these old days, the methods used were really simple. You didn't need a computer. You didn't need a calculator, really. So basically, you just took so for the original exposure method, you simply took the notional amount of the swaps and multiplied it by a factor, depending on how long was left in the life of the derivative. And it was pretty similar for the CEM, where the potential future exposure was simply 0.5% of the notional for swaps with a residual life of more than 1 year. So it was the current replacement cost plus a small add-on. So the rule set was very simple, but it's really important to understand, these were not banks' internal decisions. This was stuff that was imposed on them by regulators. So the banks had to do it, they had to report it, and they had to hold capital against it. We move on. We get to a much more sophisticated world, a world where the big banks were, and Basel II basically happened at just the wrong time, because it came into effect on the 1st of January 2007, and the final parts of it came on the 1st of January 2008, obviously just as the world's economy was blowing up. And there's a lot of new stuff in Basel II. It's a much larger document, much more complex. And now, instead of just 3.5 pages of rules, there's 24 pages, and counterparty credit risk for derivatives is its own annex of the whole new accord. In the UK, we actually implemented Basel II through through the website. It was called BitPru, the regulatory method for implementing it. And now there's not just 2 methods, there's 3. They've got rid of the OEM, which was the simplest one. They've kept current exposure method, which I explained to you briefly before, and they've got 2 other methods. Effectively, they've got, for the smaller banks, they've got something called standardized method, which is moderately complex and would take me probably half an hour to explain to you, so I'm not going to do it. And then there's the internal models method, which basically all the big banks were expected to use. And the internal models basically require you to have a lot of historical data and to model the volatility of interest rates over a period of time, and thus to model the expected level of future exposure on your credit card, on your derivative portfolio. They formally came into force on the 1st of January 2007, but it's, to be clear, this rule set was years in the making, and so the banks had very good visibility of the new rules that were coming down the track, and so banks would have been pricing for this increased measure of volatility from at least early 2006, probably even earlier. So banks knew that they were going to have to hold more capital for this potential future exposure. And that was in place, as I say. The rules came in on the 1st of January 2007, but the expectation and the knowledge was there earlier. Again, really important to understand, this is something that's imposed on banks, not something that banks have any option about complying with. And then we move on to the 3rd chapter, and we have to learn the lessons of the financial crash, the 2007-2008 events. One of the major lessons from the financial crisis was that counterparty credit risk was an absolutely major source of systemic risk within the financial services sector, primarily due to the fact that banks had enormous credit derivative portfolios between themselves, and this effectively passed on credit risk from one bank to another bank, and that interconnectedness made the whole system more liable to failure, which is what systemic risk means. So one of the outcomes from the credit crunch was this EMIR, which was legislation to solve that issue by basically forcing banks to collateralize their derivatives when they deal with each other and to move those to central counterparties. So basically, banks no longer really deal direct with banks. They may do the deal, but they book it via a central counterparty, and it's fully collateralized. So that gets rid of the credit risk between the banks. It does, of course, increase the liquidity risk in the banking system, but we won't go down that rabbit hole this evening. Counterparty credit risk is itself it put into legislation in the form of an EU regulation, which was known as the Capital Requirements Regulation. It may not sound very grand, number 575/2013, but this was the single most important piece of bank regulation to arise after the credit crunch. And effectively, although we've left the EU, this legislation still applies word for word in the UK today, because we haven't changed it, we've just onshored it. And so the same articles apply. It's just the UK version of the Capital Requirements Regulation rather than the EU version. And now you notice counterparty credit risk is not just a brief mention, it's not just an annex, it's now a whole chapter in its own right. And it's actually it is now quite a complex subject. There's 4 methods allowed. The internal model method, which we described earlier. We've got the OEM back again now. We've got standardized and we've got the simplified standardized. But it's important to know that the 2 simple methods, the OEM and the SSA, they're really only allowed for banks with very small absolute and relatively small derivative exposures. If the vast majority of derivatives that we ever talk about are with one of the big banks, and they would all be using the internal modeler method. And the other important lesson to know is that because of the experience of the very volatile market conditions that happened in the credit crunch, the add-ons are materially higher today than those that were calculated originally under Basel II. So that's been the other trend, that the add-on for potential future exposure has increased over time. And why did I set all this down, and why did I bore you by trying to explain bank regulation? I did it because one of the things I've become more aware of in recent times is that, unfortunately, we're in a world where judges make some bad decisions based, I think, on poor expert guidance. Mainly based on that, and the regulator then hides behind some of those bad judgments, yet when actually the regulation is incredibly clear, and we can see that both with the prudential regulation, but we'll see that again when Steve speaks to the conduct regulation. It's absolutely clear what the intention of the legislation is, and it's absolutely clear what an independent person with who knew the subject would come up with the interpretation. But we've got to a world where not just, because of some bad legal judgments, we've got to the world where the regulator is now effectively not even trying to impose the regulation that they are supposedly the keeper thereof, which is an incredible answer. So I wanted to just correct a few things. This case was a case that Steve drew my attention to. Was it Perks v RBS? But basically, the judge ruled that the clue is nothing more than what I called before the potential future exposure, the amount the bank has to calculate as its expected greatest exposure. It's just another language used. It's shorthand for credit line utilization, but basically it means how much are the bank having to report to the regulator as their potential risk. The clue, as the experts agreed, is a bank's internal and subjective estimate of the near worst case risk to the bank at any given time of default by the customer under the IHRP. Well, some of those words are true. It is a near worst case risk. That is true. But it's certainly not just an internal and subjective estimate. And the expert that agreed that on behalf of the claimant was not an expert, because they should never have agreed it. It's internal models method is a very, very objective and quantitative approach. It's highly data based. It's very mathematical to very, very high levels of confidence, and it's policed rigorously by the regulators who approve the internal models. So it's hardly an internal and subjective estimate. So that's the first thing I wanted to disagree with them on. The next thing I wanted to say was, obviously, and I think I hopefully proved to you, that counterparty credit risk is a formal regulatory requirement. It's been there since 1988. Banks are legally required to calculate the amounts using one of the one of the designated methods and approaches, and they have to report it to their regulator. It's part of just all of their regulatory returns include their risk-weighted assets and how much they have of risk on their balance sheet and off their balance sheet. So it's a regulatory reportable matter. They have to disclose it externally in their annual Pillar 3 disclosures, and they have to hold capital against both the on-balance sheet and off-balance sheet risks. And just as an example, I looked up a recent one that was disclosed by Goldman Sachs. And Goldman Sachs UK, sorry, just the UK operation of Goldman Sachs, and their Pillar 3 disclosure disclosed this amount. And basically, won't surprise you perhaps, because they're a very, very big trading business, but over a third of their total risk-weighted assets, i.e. over a third of the risk in their business, relates to counterparty credit risk as at the 31st of March 2023. That requires a lot of capital. That probably requires $15 billion worth of capital to cover that risk. These are big risks that the banks are running. The regulatory requirement, as I say, is to calculate this potential future credit exposure. As this amount varies daily due to movements in interest rate expectations, the way that banks handle that is they typically mark a credit limit on their system that's significantly higher than the PFCE. So they actually mark a credit limit that's above the number we talked about. If we were using the language of clue, they have a credit limit that's bigger than the clue, if you see what I mean. These derivative limits are hard credit limits. They're not just made up numbers. They are hard credit limits, and they're treated exactly the same as loans and our overdrafts. And in fact, we have I've seen recently a letter from one of the Magic Circle law firms, and they confirm that word for word, that derivative limits are hard credit limits, treated exactly the same as loans and overdrafts. Again, that's been the source of quite a lot of disagreement over time. It's absolutely the norm for banks to include derivative credit limits in the numerator of any LTV covenant ratio. I'm not saying there isn't one example out there where the bank hasn't, because there could always, if a bank has decided not to include it and has said they're not going to include it, that could be the case. But in 99%, if not more, the bank would have included this credit limit in the numerator of the LTV covenant ratio. That's my personal experience as a lending banker. I've also seen quite a lot of credit sanction documents that attest to this fact. So, as I say, for at least 99% of customers, these credit limits, which were not disclosed to customers, would have impacted their LTV covenant ratios. And then this next quote, again, it seems to be the expert's fault. The same judge ruled that since the clue is the bank's estimate of the risk of default to the bank, the experts agreed that the clue is not a contingent liability of the customer. It's actually hard to know where to go with that, because firstly, the clue isn't really the estimate of the risk of default. It's more an estimate of the exposure at default. So that's very different. Risk is a function of both exposure and probability. So he's got his first part of the definition wrong. And then the second point is, I couldn't disagree more. There is nothing more. It is the ultimate definition of a contingent liability. A contingent liability is a committed undrawn facility is the perfect example of a contingent liability. So it's incredible to me that an expert could have agreed that, and a judge could then make that in his final summing up. So yeah, I just thought that would perhaps set the scene to say that we live in a world where what is absolutely clear in regulation, what is absolutely clear in the intent of the legislators, seems to end up being twisted by some bad pleadings by claimants. And I guess that's probably the thing I learned in actually producing this document. I didn't learn anything about the prudential rules themselves, but it did make me realize that actually the banks have played this very cleverly in the way they played the legal system, because I think it's reasonable to suggest that the banks have let claimants progress through the courts where the claimants have not done a very good job at putting their pleadings together, and have used experts that weren't experts and have made the wrong arguments. And so that has gone to final judgment, and the judges have thus made decisions based on bad evidence. Whilst in contrast, if you've actually made your arguments extremely well and coherently and powerfully, the banks don't tend to go as far as the court and avoid any judgments that go the other way. So you end up in a world where actually the regulator is relying on judgments based on bad law, really. Yeah. Okay, so that's I think that's me. Are there any questions though, just on that aspect, or if not, I would suggest we move on to Steve and his presentation.
What we're going to do in just a moment is we're going to move on to Steve.
Okay.
For those of you that have questions and comments, and I hope you do have questions and comments, we're going to cover them off when we get to the end of Steve's presentation.
All right.
I'm sure everybody's going to want to join me in thanking Ian. Ian, I'm going to get a T-shirt made for you. Ian Tyler, the good banker. Okay. Can we please show appreciation to Ian Tyler? Thank you very much indeed. Well done, Ian.
You won't need to make too many copies.
Very good. It may not be a very profitable line. Thanks, Ian. Great stuff. It's really very valuable to have somebody with your background, experience, and pedigree in the world of banking at a very senior level, speaking so openly and so frankly, and so truthfully about the sorts of things we've been hearing tonight. Thank you very, very much indeed. I definitely have some questions and comments, but we'll get to those later. And I'm sure others feel the same way. Mr. Steve Middleton, over to you, please, Steve. Thank you very much. And take it through nice and gently, Steve. Let's assume people are like me, don't have a very high existing level of knowledge. Thank you, Steve. Thank you.
Thanks, Andy. I'm going to apologise in advance for the number of slides I've got here. It's not that I expect you to go through in massive detail tonight, but they'll be there and distributed, so you can go back and have a look later on and have a look at the rules, have a look at your own case, see if you think it applies in your case. But I thought it better because part of the problem when you're dealing with FCA rules is that if you don't quote the whole rule at times, you can miss quite a lot out just by leaving 2 or 3 words out in terms of the meaning. What we're going to look at is really how the rules should have applied or do apply or did back in the day had people sold these products compliantly. So I'm just going to go to my share screen. Hopefully you can all see that, can you?
Yes, we can. Perfect, Steve.
Right. Okay. Now,
I'm pleasantly surprised how well that went.
No, but this is the bit where I always hit the problem where I can't move the slides forwards and backwards. So I'll warn everyone in advance. And the minute I stop doing that, then Andy or somebody else will kindly take over, no doubt. So IRHP sales rules, IRHP, quite simply, interest rate hedging products. They are largely swaps, can be caps, and could include, in certain occasions, fixed rate loans. And certainly I would include ones like the Ulster Bank, where you do have the margin credit or credit lines available on those loans, whether it's through a fraud or for any other reason. I've called it 8 million reasons for an expert to know the rules. That's just because, quite simply, when I think you spend several years having an expert allegedly in these areas look into the matter of the interest rate hedging product review, which in this case was John Swift KC's team, and that report costs around or more than £8 million, then I think they should fully understand the rules and how those rules should have protected people back in the day, because to not do it, to not understand them, can mean that people who already didn't get the right compensation or redress or protection at the time, they have that position exacerbated, which I think is exactly what's happened here. Okay, so what was said in the Swift report and what was said to the Treasury Select Committee by John Swift KC and his colleague David Capps. Now, after the report was published, I, for one, I'm sure a few people commented, but I sent a report to John Swift and raised a lot of concerns about things he hadn't covered and about matters that I believe were incorrect in the report, specifically around this issue of credit lines and margin credit, and also in relation to fixed rate loans. He was obviously quite clearly conscious of criticism he'd received, and I say it probably wasn't just me, it would have been others. Certainly Paul Carlier had tried to get many of these facts over to the Swift team unsuccessfully. And so when he went into the Treasury Select Committee to ask some questions about this, he was specifically asked about these credit lines. And I along with one or two others, had helped prepare some of these questions in the background that were asked of him. And his responses were quite shocking, really, both in the report and to the Treasury Select Committee. For somebody who is an expert barrister and judge, he'd actually put in his report in relation to this issue of credit lines, he calls it contingent liability. He says the question of contingent liability was not covered under FSMA, nor the principles and rules made under it. Now, to those of you not aware, FSMA is the Financial Service and Markets Act, which came in 2001. And that really brought in, or should have brought in, lots of protections for investors, particularly when it came to more complicated products. So he says this question of contingent liability, which is what he calls the credit lines, was not covered in that act, nor the principles and rules after under the FCA, and they obviously are all covered in the FCA's handbook. He then goes on to say, I use the words contingent liability has the same meaning as the utilisation of credit limit. Now, we're starting to get confused already because we're back to this CLU thing, or utilisation of credit limit, which is what the banks and the judiciary have attempted to state is simply an internal risk and not a risk on the client, which is completely wrong, as Ian's just explained in his presentation. When he was asked at the Treasury Select Committee about the credit limits, he suggested that it didn't matter that people hadn't known about this. Now, you think about that. Someone's selling you an investment. That investment carries a credit risk. Now, that credit risk on day one is largely down to a big commission they've taken that they haven't told you about. Now, had they told you about the commission, they would have had to have charged you, and you'd have had to pay out or written a check for that commission and that charge, and you would have known about it and asked a lot of questions about it. But they didn't do that. They covered that by putting credit in place in your name without telling you. So that started the position by covering what I would say is a secret commission. They call it added value most of the time, but certainly it's a charge or a cost or an expense. It's something that comes out of your account. And then it also covers some of this potential future exposure that Ian has said. So at the outset, you are losing money on an investment. Now, I would say, and sorry, just when I say an investment, just let me clarify there. When I go through these rules, I just like to sort of take a step back and not think about I was protecting a loan. You were actually, anybody who bought a swap was actually buying an investment. Yeah, it is a contract for differences. It is a gamble on interest rate forecasts and future rates that you will either win money on or lose money on. That's the actual, it's deemed by the FCA to be a complex financial instrument. So if you were buying one of these products, would you have wanted to know about the initial commission? Would you have wanted to know about potential losses? Well, Swift seems to think that you wouldn't, that it wasn't relevant. That in itself confuses me, because I've spent many years selling all sorts of types of investments, and we always had to disclose our commission. And a big part of why we disclosed it was the commission we received a skew on the product we sold? Were we selling products that gave us more commissions? So that makes no sense to me whatsoever. And he goes on to say is that his understanding that there's no requirement under COBS to disclose this credit limit. So this initial loss that can get massively bigger when interest rates drop. So he says contingent liability is a credit limit. It's not in the rules. We don't have to disclose it. Okay, so David Capps, who was working with Swift, went on to say, and interested in this, that they said the expression we have seen used is not margin requirements, but the expression margin credit by commentators. Again, he goes on to say the margin credit is just another way of saying contingent liability or CLU. We don't think that this expression margin requirement is really engaged, which is a fascinating statement. When you actually understand what a derivative is and what you're buying, it's fascinating, just bordering on ridiculous. But as you'll see when we move further on, he does go on to admit, oh, actually, there is a reference to a requirement to disclose contingent liabilities, which is actually the opposite of what John Swift KC has said, who's been working with him for several years on this report. But he goes on to say, my understanding of Swift's findings is that banks were not under an obligation to disclose their internal credit limits. But Swift's findings came from Capps, who's more of an expert on derivatives than John Swift KC is. So why is he quoting what John Swift is saying in the report? Because that's what he's saying. And he said it wouldn't have made any material difference in an assessment of mis-selling. So go back to what I've said. If you start buying investment, you're losing money at the start, and you can lose substantially more money, hundreds of thousands, millions of pounds, and that was not disclosed to you. Do you not think that might have made a difference when you went into the interest rate hedging product review or took a case to court or anywhere else to know that the bank already knew you were going to lose money at the off? Surely it was foreseeable then that this product might do you some damage, which is what they denied in the review. So what Cap says is margin credit, CLU, contingent liability. Let's not worry about it. Let's call it all the same thing. It's got all the same. Let's call it break costs. Break costs are obviously what you pay to get out of a derivative. It's not the credit risk while you're in the derivative throughout the period. So did Mr. Swift KC and Mr. Capps mislead the TSC about margin credit? Well, you can make your own mind up as you go along. I think you might gather where I'm going with this already. Is contingent liability in the rules? Do you know, if I was being paid millions of pounds to produce a report, which I'm going to be deemed to be some kind of expert, I might do this simple thing of going to the FCA's website, getting up the handbook and typing in contingent liability on a search. Yeah. Bearing in mind, John Swift KC said it's not in FSMA, it's not in the rules. When you do a simple search in the handbook, it comes up with 101 items on contingent liabilities. Yeah. So it's not only in there, it's in there 101 times. Now, admittedly, some of those are later, but when I looked at it, there's about 56 items up to the time period of the review starting where contingent liability is included in the handbook. So how could you possibly make that kind of error? Interestingly, that error was made and it wasn't picked up, and margin was not included in John Swift KC's report. And that just happens to be that margin, that risk, happens to be the reason why almost nobody got consequential losses in the review. Now, I would say that's quite a big error, but again, we'll see as we go further through why I think that's such a big issue. So again, Mr. Capps has said that these products are not really anything to do with margin requirements. So again, it's quite useful. Go to the FCA's handbook, go to the glossary. What does margin mean? Margin means cash or other property paid, transferred or deposited under the terms of a derivative. What does margin lending transaction mean? Now that's interesting. Rather than do a clear explanation, they say, has the meaning of point 10 of Article 3 of the SFTR. That's the Securities Financing Transaction Regulations. In simple words, when you go to that section, it states margin lending transaction means a transaction in which a counterparty extends credit in connection with the purchase, sale, or carrying on or trading of securities. So any form of credit when you're buying a security or an investment. Look at margin contract. Margin contract in the glossary in the FCA handbook says any contract in derivatives. And then look at margin transaction requirement. The total amount of client money a firm is required to segregate client bank accounts for margin transactions. Now, I would say margin requirements are not only engaged when it comes to looking at swaps, they are central. It is a margined investment. So again, quite how Mr. Capps could make that statement to the Treasury Select Committee is beyond me. Are margin requirements part of a swap sale? So Schwab, the online investment house, they say margin lending is a flexible line of credit that allows you to borrow against securities you hold in your brokerage account. So keeping it simple here, we've spoken about it before, so to some degree I'm treating you all as people who have an understanding to some degree of the subject. When you buy this fixed rate on the swap, if rates drop in the future, you'll be paying more money across to the bank. You will be losing more money because you won't get the benefit of rates dropping, and they will make more money. Now that leads to something called margin calls, which I think most of you might have heard of now, and certainly in relation to the LDI pension issue. That basically means that as you lose more money, the bank need more money off you to cover those potential future losses. That's a margin call, yeah. So it's an integral part of a swap. So all over-the-counter swaps, over-the-counter simply means bespoke. You can't go and buy it off an indices somewhere or trade it on indices. You're simply having that product built back for you by the bank. So all over-the-counter swaps and fixed rate loans with credit lines contain direct derivative exposure with margin risk. Where the risk isn't recovered by cash, so in other words, if your risk increases because rates drop, if the bank says to you, look, you've got £1 million sat in that account, we're going to take more of that off you now to cover this risk. If it's not covered by cash, they have to loan you that money, effectively advance credit for you. So when David Capps says we don't actually think this expression, margin requirements, is really engaged, he couldn't have been more wrong. It's completely engaged. It's central. Margin risk, margin credit risk is the biggest risk on a derivative. Now, just to explain that, I've shown this similar file before, and all we're looking at here is a customer, and this is a real case where they had a 5.2 million loan, and they had a swap in place, and it was over 25 years, so it was a very long swap, a very controversial one that should not have been done. The break cost, and this would have been in about 2013-14, when they first looked at trying to get out of the swap, the break cost to get out of the swap was 1.9 million. However, what they didn't know was in the background, the credit risk that they were in on the swap was 3.8 million. So on the bank's files, they didn't owe 5.2 million on the loan, they owed 9 million. They owed 5.2 million for the loan and another 3.8 million for the credit risk for this future, which included the break cost, but also the potential future risk. Now, that means if they wanted to go to another bank and replace that lending, it wasn't a case of borrowing 7.1 million, the break costs and the loan. They would have had to borrow 9 million to cover that risk if they didn't want to break the swap. Now, I'm not trying to be clever here, but do you not think we should be able to ask Mr. Capps or Mr. Swift, do you think a 3.8 million risk is bigger than a 1.9 million? Now, again, it makes you wonder what £8 million does really buy you. Just to show that it's a real liability, this is an example of an RBS credit file. And you can see on there, there's two loans that relate to a swap, A1, A13, 743,458. There's 188,000 credit limit. That relates to the swap covering those loans. Now, this is a case I worked on. 3 months after they took the second loan out, 3 months after, there's a discussion internally between the bank managers about what they're going to do, because they thought this original £100,000 credit limit will cover both loans, but because rates have been dropping, they've now got a problem, and it's going to breach the loan to value. What do? We can't tell the customer. Well, what do? They go to the customer and accuse them of producing their accounts late and send them to GRG. So that increase in credit limit broke their loan to value and pushed them into special measures. And this is what happened up and down the country in all the various banks. And what that will show you there, if you look at the figures, the total aggregate lending is 1.408 million. That includes the swap credit line. It's a hard limit. So some of you may have seen the cases in the Times in the last couple of weeks. It included a case of Vincent Howell, a publican in Northern Ireland. He had a credit line on his fixed rate loan, which started at £50,000. in January 2008, when interest rates dropped, that gone up to 304,000 by March 2009. 40% additional debt on his credit file. That's what pushed him into GRG and into special measures. So the swap credit lines, they damage your credit rating. So the banks have credit ratings for your loans. I think in RBS it's something like 1 to 29 MSG. And what will happen is, as the swap credit line increases, your indebtedness increases and it damages your credit rating, so you can borrow less money from that bank. It puts you in the same position if you want to go to another bank. It can stop you rebanking. So again, this idea that if you haven't been told about the break costs, it's irrelevant that you haven't been told about the swap credit line is ludicrous. Because a lot of people were pushed into insolvency, never having missed a payment on the swap, simply because the credit line breached the loan to value and put them into an insolvent position with their security with the bank. Should a client be told about this? Well, I think that would already be self-evident, but Mr. Swift doesn't think it's in the rules. COB 16, so Conduct of Business Rules from the FCA's handbook. Trade confirmation should include the total consideration. So when you do a swap, you're supposed to get a trade confirmation within a day. It should include the total sum of commissions and expenses charged, and the rate of exchange where the swap involves conversion of currency. Now, all swaps back then were being denominated in dollars in the background, so you also get a currency conversion risk. And I've seen that on some cases where there's been massive increases in the swap credit lines because of forecasts on sterling weakening against the dollar. So yes, you should have had basic information the minute you took the trade out. It also tells us that if a bank operates a retail client account that has an uncovered open position and a contingent liability transaction, that basically means that you have a credit facility in the background that isn't capped. Then if you reach the extent of that cap or that current limit, that they should notify you within a day. So you should be aware of this credit facility at the outset and the risk and notified every time it goes up. Now, I'm not going to go into too long about this, but just under the original rules prior to 2007, you had categories of customers where you were a private customer generally up until being a firm with 5 million net assets and more. And then above that, you've got your bigger companies, your listed companies, your authorities, your banks, your counterparties, and you have something called an expert private customer. So that's somebody who's an investment expert who could still buy a complex product. So your target market should have been from intermediate customer upwards. And really, if you're selling such a complex product as a swap, you should have only been talking to private customers who were experts or expert investors. When something called Markets and Financial Investment Directives came in 2007, November of 7, it extended protections for what were now becoming retail clients. So you are now a retail client unless you're a professional or an eligible counterparty. Well, eligible counterparties, banks, governments, that type of thing. Professional firm, to be a per se, so in other words, you're always classed as professional, you had to be a large undertaking. So you had to have a balance sheet total of 20 million euros or more, net turnover of 40 million euros, or earned funds of 2 million, 2 of the 3 of those. So everything below that now became a retail client. And the whole point of that change in categorization was to provide additional protection for those people in the retail client bracket, particularly on complex financial investments. So what were the rules prior to MiFID? Well, it was very, very straightforward. COB 7.9.3, if you look when I quote a rule, that you'll have 7.9.3 an R. R means it's a rule. Rule means that a private person has a statutory right to bring a claim for a breach of that rule. Yeah, so effectively it's a legal position for private persons. And then you'll see 112.01. So you'll see that was a rule from 1st of December 01. So you'll see that on each rule I put out, you'll see what date it was from and whether it was a rule or not. So it tells you the firm must not lend money or grant credit in its investment business unless it's assessed the customer's standing, taking reasonable steps to make sure the loan or credit are suitable, and the private customer, which was the old category, has given his prior written consent to both the maximum amount of the loan and or credit. Yeah, so if you're selling a swap and you're starting with a £100,000 credit line, you should know about that credit line, but you should also know that it could extend way beyond that if rates drop. Those are the rules, very simply. They carry across into COBS 14.3.2 post-MiFID. So post-November 07, you've got to make people aware so they can make an informed decision about the risks in the product. And you'll see there that in point C, it talks about any, sorry, I'm on the wrong page here. Point C, it talks about the fact that the investor might assume financial commitments and other additional obligations, including contingent liabilities. That phrase again that Mr. Swift thinks isn't in the rules. So you would have to make them aware of that. And if you look at point D, you have to make them aware of any margin requirements or similar obligations. Now, when SMEs were sold these products, they didn't have £1 million in shares or securities that the bank were broking on their behalf, and they could use that to cover margin calls. They had properties. Yeah, they had offices and factories and that type of thing. And therefore, they couldn't just cover these risks through those assets. So the bank was lending further credit against those assets and securing that credit through its all monies charge. But you had to know under the rules post November 07, you had to know enough about this to make an informed decision. Well, you can't make an informed decision unless you know not only the full extent of the starting risk, but what that risk may go to. So again, the idea that there's no obligation and no requirement and no reason, absolutely nonsense. Was it appropriate to provide margin credit? Now, this was a new rule that came in MiFID. The whole point of this was to remove this guesswork around who could or couldn't have these products. So you had to talk to a client about their investment expertise, check their knowledge. And what you'll see there under COBS 10.2.2b, it will tell you that you can assume a professional client has the necessary experience and knowledge to understand these risks. So if the client's professional, then fine. If not, you've got to build what they call an appropriateness file. So how often have you bought products like this before? What's your knowledge? What's your experience? What's your background? What's your expertise? Yeah, these sort of questions. Now, what would happen if you went through all those questions and found that the person didn't know what margin credit was, didn't really understand swaps, didn't understand a leverage investment, yeah, didn't understand the credit risk long term? Well, the rules are very simple. If you've considered, based on what a client tells you, that it isn't appropriate to sell you that product, then you've got to warn the client. Simple as that. Go through it. Oh, I've never bought a swap. I don't understand margin credit. I don't understand this risk. I don't understand this volatility. I can't sell you it. And not only can I not sell you it, I've got to tell you shouldn't buy it. I don't think that's really anything other than straightforward. Who could you sell it to? Well, you could sell it to people who understood what they were doing. So you would have something called elective professional client status. Now, these are the sort of people you should have been possibly selling swaps to. But you can only, so this is a retail client who turns around and says to you, well, Steve, look, I know what I'm doing. I'm an expert. I've been buying stuff for years. You know, Telegram with how to suck eggs, you know, I want to buy it and go ahead with it. Okay. So what I've got to do is a quantitative and a qualitative assessment under those rules. So I've got to check with you what your experience and knowledge is where it's from, what capabilities you've got, what qualifications you've got. And I ask you questions such as how many transactions you've carried out of a significant size on a relevant market, yeah, up to at least 10 per quarter over the previous 4 quarters. So how many swaps have you bought in the last quarter? What size were those swaps? What level of risk was it with those swaps? What type of swap did you buy? The portfolio for the client at that level should exceed €500,000. Now, that's not commercial lending, that's their investment portfolio. And the client should have worked in the financial services sector for at least 1 year in a professional position that deals with those matters. So if you want someone or somebody wants to buy a product like this and they're a retail client, that's the level of expertise they've got to prove for you to be able to sell them in real terms. That's how it should have worked. I would suggest that 95 to 99% of those who bought the swaps back in 06, 7, 8 onwards would have failed the appropriateness assessment. If they failed it, you had to tell them you shouldn't be buying the product. So what about sophisticated clients, this lovely category that ruled 5,000 people out of the IRHP review? Well, there isn't a category called sophisticated clients. There isn't one in MiFID. There isn't one in the FCA glossary. Look it up. Again, I just wish that John Swift had done and Mr. Capps. Then they might have realised that what there is here is a twist on words. There is something called a sophisticated investor or customer, and that is somebody where they've got substantial expertise and experience in a certain area, like buying hedge products or buying complex products, and you can then sell them or promote to them complex products and unregulated products. But what you have to do is certify them. So I've given you an example there. That's straight off the FCA's own website. If you want somebody to be sophisticated, you've got to certify them. Yeah, but they're not sophisticated.
We'll be there in a minute.
Yeah, sorry, I'm getting feedback somewhere. So there is no such thing as sophisticated client under MiFID. Now and you'll notice the weasel words as I've suggested there, that when you deal with anything to do with the FCA over this, they go from people being retail clients to sophisticated customers, or just categorised as sophisticated, yeah, to cover up the fact that it's not a real category. So how would you compliantly sell the swap? You categorise a client as a retail client, explain all the risks of the swap, including the break cost risks, including the margin requirement for margin credit, and the extent that may go to. And that would be explaining if rates go down to nothing, that could your original credit risk could increase exponentially. If the client wishes to undertake or go ahead with the swap, then you do the appropriateness assessment, and then you keep that on appropriateness file, so you could always prove in the future that the person bought the right product for their level of expertise. If it's not appropriate, the client doesn't have the expertise, you must tell them that it's not appropriate for them to buy it. If they do have the expertise and they want to go ahead, then you do the tests, as I've said, you do the quantitative and qualitative assessment. If you decide they are at that level of being a professional client, then you can look at selling the product to them. They will have to go ahead and, as Ian quite rightly said, then negotiate the margin terms and everything else under an ISDA credit support annex, but you can sell the product to them. But what you can do, if you want to, is allow the client to retain a retail client status rather than taking professional status, because they get more protections. So I say that is the only way you can sell that product to a retail client if you want to follow the rules. So in summary, contingent liability has always been in the rules since 2001. All derivatives are margin transactions and therefore subject to margin requirements, despite what Mr. Capps said. Margin lending relates to any credit advanced to a client. However you do it, whatever you're doing, you're lending them money, you're giving them credit, it's a margin requirement. That had to be disclosed under COB. It has to be disclosed under COBs. If a person doesn't have experience in margin transactions, it's not appropriate to sell them a swap product, or wasn't after November 2007. Credit lines and margin credits are not the same as break costs. They include the break costs, but are a higher level of risk. It can be twice as much or more. The margin credit risk is the largest risk a client will face from a swap. As I said, it could be twice as much or more. When you're selling investments, what you should be telling people is worst case scenarios and highest level of risk. It should be the first thing on the agenda. So you can take your own view on it. My view is very simple, although he did perhaps a decent job on the sophisticated client area. I believe that Mr. Swift, KC, inadvertently or otherwise, and Mr. Capps misled the TSC about the facts, the rules, and what should be disclosed.
Remarkable, absolutely remarkable. Steve, are you wrapped up there?
I'm wrapped up there, yeah.
Well, folks, that really clearly, obviously deserves a massive round of applause. That would have taken a huge amount of time and effort to prepare. It's about as crystal clear as anything like that could be. So, Steve, thank you very, very much. And also thank you very much indeed for your first session here. Both of you have done brilliantly well. And of course, please understand this, folks. These guys are doing what they're doing on a purely voluntary basis. I'm not paying them a fee to come here and spend a lot of time presenting and preparing information like this. So thank you very, very much indeed, Ian and Steve. Okay, well, we're now going to go to Q&A. I'm still not seeing myself properly in Zoom.
Well, Andy, do we want to do before we do the Q&A, do we want to do the
No,
angelic
no.
interiors?
We're gonna go to angelic after we've done an initial
Okay.
Q&A. So what we're going to do, folks, is we're going to cover, if you like, generalities and principles and rules and regulations. And once we've kind of done that, we're then going to look at how all this apply to a very, very important case to do with angelic. All right. So, folks, please raise a hand either literally or digitally. We're going to go to Barbara Williams first. I think this might be Barbara's first TTF meeting. So, Barbara Williams, we're going to go to you first of all, but please do briefly introduce yourself and then make your point. I am going to ask everybody to be as succinct as possible, please, so that we all get a chance to say what we want to say. After Barbara, we're going to go to the great Mr. Nicholas Wilson. Barbara, to you first. Thank you.
Risk and probability. I learnt a huge amount. Thank you very much for the presenters. I'm coming in from a totally different angle in that I'm a degrowth activist, very concerned about ecosystems collapse and the possibility of financial systems collapse. Now, obviously, all of these products are subject to the global collapse that I'm seeing possible. Now, I can't see any way that our current arrangements for assessing risk can be adequate to cope with what's around the corner at the moment.
I'm going to pick up on that one, Barbara, rather than take up Ian and Steve's times with it. So Barbara has a very, very clear set of thoughts around the urgent need for there to be degrowth to get the system, the totality of the system back into balance and back into equilibrium. And I really encourage everybody to take time to consider the thoughts that Barbara has. Barbara, please do feel free to put into the chat some links to your work and some of your essays. I think some of you will find that very, very interesting indeed. And in summary, Barbara's concern here is that there's a real risk that there could be rampant out of controlness in relation to risk around the ecosystem as a whole. Thank you, Barbara, for raising that point. We're going to go to Nicholas Wilson, who's the chap responsible for a whole load of good stuff, including some recent explainer videos that Nicholas has done. Nicholas, to you, sir. Thank you.
Thanks, Andy. Very, very quick one to Steve. Steve, you ended your excellent presentation saying that SWIFT had misled the Treasury Select Committee. Was it deliberate?
I think probably I disagree with a few people on this. I think I see very well rehearsed statements coming out from SWIFT and CAPS, well rehearsed, very carefully worded, conflating contingent liability with break costs and ignoring and not understanding credit lines. I've got to say I believe it was intentional, because I wrote a 15-20 page report to SWIFT, and he should have read it, whether he read it or not. If he'd read it, he wouldn't have been able to make any of those statements. And I included the rules and how we got the rules wrong and everything. And I wasn't trying to be clever with him. I just think it's appalling that people 10 years, 15 years later on are still not getting justice because the rules were not complied with. So yeah, unfortunately, my view is it was, yeah.
Did he respond to you?
No, didn't even acknowledge it. You'll notice when he was in the TSC, he said about people criticising, and dare I say, even this report were his words. And I tried to speak to CAPS after the meeting, and I said I'm concerned because I believe he just misled the TSC in there, and I think it's very important that you don't do that. And he wouldn't speak to me. Walked off.
Let's talk this through, folks, because I think what's being discussed right now is so important. And obviously none of us know definitively what's happened, but let's look at what we absolutely do know. I think I'm on safe ground to say that the nature of the review, the scope of it, was the architect of that was the FCA. Am I right in saying that, Steve? It was the FCA who basically decided what the SWIFT review was going to cover. Is that right, Steve?
Yeah, it was a 166. And what I mean, I've got numerous emails with it. I accused the FCA of replacing the rules with lower level sales standards. And I said specifically they did that on purpose to remove the contingent liability risk. Because as I've always said, if you sell somebody a loss-making investment and lend them money to cover that risk at the same time without telling them, it is always foreseeable you're going to cause them damage. And every consequential loss case failed on the fact that we didn't know where interest rates were going to go, and it wasn't foreseeable that selling of the product would do you damage.
Thank you. So if we work on the basis that it was the FCA who were the architects of the scoping of the review, I think I'm right in saying, Steve, and Ian, correct me if I'm wrong, it was actually the non-exec directors of the FCA who decided that a review was necessary, and they scoped it out. Am I also right in thinking that the FCA had some influence over who did the review? Is that a fair statement as well, Steve?
I couldn't say definitively on that. I think the reality was, I suspect with each bank, they were all picking a safe pair of hands between them and the FCA, because they were all picking their auditors or long-term mates and people who they knew. Let's be right, you know, half the people involved in this were the very firms that had audited the bank's accounts when all of this was going on, and didn't spot any of this issue or wrongdoing.
I'm going to put another question to you, Steve. So roughly, it doesn't need to be a precise number, but roughly how many people provided Swift and/or his team with detailed information that was highly relevant and highly important that for some reason didn't appear in the report at all?
Well, I had one quote in the report where I'd said this was criminal. That was the only thing I think. And then there was 2 or 3 other references to cases where the FCA had written to me. Paul certainly took a massive information in, and I think all of his was dismissed. Certainly now Andy Candy also wrote into them and gave them a load of information on the credit lines. I can't imagine we'd be the only ones, but I think I don't know if Pete Crowley went in or not, but certainly I know 3 or 4 gave very specific information. And I said to you, you know, obviously we've covered the Ulster Bank thing. I gave them all of the documents on the Ulster Bank issue as well, and those fixed rate loans.
I'm going to stay with this line of thought, Steve, because I think we're getting to the heart of the matter here. So a few people gave Swift and his team hard information that could have and should have been included. In your opinion, had the information that yourself, Paul Carlier, and others, had it been incorporated into the report and the thinking of Swift and his team, what would the significance of that been? How would the outcome of Swift's report been different? I know this is conjecture, we can't know for a fact, but in your opinion, if that stuff had been included, what difference would it have made?
I think they would have had to redo the review. You know, I mean, I'm engaged with some cases on this current Foskett panel, which is a redo of the Griggs review, and you know, people are even thinking that Dobbs might end up overdoing Foskett. I think they would have had to turn up the review, because there were so many people, and the other thing the review never did was never dealt with insolvency, and this is why they've had 10 years of covering this up, because once people know the fact that their company was pushed into GI Joe insolvency because of a debt they never signed up to and knew nothing about, then the position is exponentially different to where it is now. They just allowed the fact that all those people are pushed into insolvency and lost their assets to just by the by. You know, they were taking money back in the administrations and insolvencies from the compensation scheme. So they'd have to redo it all, Andy.
And
Well,
I'm gonna,
Steve, can I just say, I'm not sure he'd have to redo all of it, but there would have had to be a massively more important emphasis on the whole subject of consequential loss, and you know, because basically he tried to sort of airbrush it out, but the reality is that it would have been it's the consequences of these credit lines that actually drove significantly bad behaviors. And of course, actually, this wasn't dealt very well with by the expert, you know, the skilled persons, because it had been outscoped of out of their work in the first place. So he would have had to be critical of the FCA for the way they'd scoped the skilled persons work. So it would have been it would have been some I still think the majority of that report would still be the same, but it would have been very much more critical. He'd have been critical of the FCA, he'd been critical of the skilled persons, and he would have had to say there was a massive failure to give consequential loss. They're probably the major.
But I think where I probably slightly disagree with you, Ian, is people were extremely badly damaged. You know, this was a time when rates were brought down to help companies at a time of extreme financial distress. So not only did these guys get saddled with these higher rates, yeah, they had these massive liabilities at the same time. So they couldn't, at a time when they desperately needed to borrow money more, they couldn't borrow anything. So
No, agreed.
I suspect there's only about 10% of cases I came across where people who probably, one, they got their money back with interest, probably were back in the same position they would have been in, and still had their businesses and everything else, but it was a small number in.
Steve, do you have one more question from me? Then we'll go to Mark Bannister, then to Abhishek. Steve, pull a number out of the air for me. Roughly, how much money do you think is the redress being paid out less than it ought to have been had the sorts of things that have been explained tonight been properly and fully taken into account? Just a very, very rough number. What sort of quantum of money are we talking about?
Well, a lot of people were talking about around 30 billion from the review when it first came out. Now, you obviously probably have that by getting rid of the sophisticated client category. But I would personally have said, had you dealt with it properly in the consequential losses, because you've got to bear in mind, Andy, that a lot of people got swap for swaps. And, you know, I was sat in meetings where they were trying to resell other swaps. And I would sit there and say to the advisor doing this, because they brought in independent advisors to do it. And I would sit there and say to them, you do realise you are breaching MiFID as you sit here under the rules. This person wasn't capable of buying the product last time it was missold to them. You can't missell them a further product in this meeting today. And you do realise the bank are paying you independently. I hope you've got PI cover for it. And honestly, they used to go white, some of these guys. But RBS replaced almost half their missed sales with other products. So I think you'd have been 20 billion upwards, is my honest view, if it'd been done properly.
Isn't it interesting, Steve? So we've got Clive's got a figure of 18, Abhishek 15 billion, Andy Candy 10 to 15, tens of billions easy for me and Lightbody, and similar figures from yourself. We're talking about a lot of money here, aren't we? And arguably, a lot of motivation for things to go the way that they did. Mr. Mark Bannister, you're next, sir.
Hopefully you can hear me.
We can, yes.
Good. I'd like to thank Ian for his contribution. Around this business of the CLU, I just want to see if I can simplify this for perhaps those participants who are not as well versed in it as Ian is. Basically, if you have a liability as a customer, the bank has the opposing position. It has an asset. So if the bank has an asset on its books, which it is being forced by the regulator in the form of the CLU to make a calculation for its risk, which is the basis of that, then it stands to reason that the opposing side, i.e. the customer, absolutely, unequivocally has a liability. Now, in the cases that Steve quoted, particularly the Perks case, or Ian mentioned that Steve had brought to his attention, it was suggested that the liability was not crystallized until the break cost was imposed. But that simply cannot be and cannot stand, because that would suggest that the bank had no asset until that time. And obviously that is not the case. So and that lies at the heart of the deception and the ruse that the authorities have used thus far to bamboozle the courts all too successfully. So that's point number one. And then point number two is we have a rather interesting situation. And I'd like to quote Edmund Burke, which is, the only thing necessary for evil to triumph in the world is that good men do nothing. Now, I think we're all good men here. And I think what comes out of this evening is demonstrably clear that a gross deception has been perpetrated on us all. And it has been perpetrated on us all by the board of the FCA, because the board of the FCA have accepted Swift's report with no commentary about the failings that we are highlighting this evening, particularly those that Ian has drawn our attention to, and Steve. And I'm sure Paul Carlier will also address in another context in a moment. And it strikes me that if we can have a situation, and irrespective of your position on it, where a stupid idiot at the World Football Cup plants a kiss on a girl. Now, I'm not wishing to suggest, or of one of the players, I'm not wishing to suggest that that's not a hideous circumstance, but I would have to tell you or believe that in terms of impact, what we're discussing here is vastly worse. We are talking about people losing their money, and in many cases, people have lost their lives. They've either committed suicide or they have suffered poor health and the implications of stress and all those types of impediments upon their lives, and being wiped out as a consequence. It suggests to me that it's beyond clear that the board of the FCA and its chief executive should have no place in their positions. The whole jolly lot need to account for this, and now, or resign. And we, as good men, need to do something about forcing that position. And I hope that everybody would consider joining in and pursuing that, because we cannot have a circumstance where our regulator and those in charge of it undermine the very rules they're supposed to be upholding. And that's the end of my contribution.
Mark, I totally agree with you. You said it actually more clearly than I did, probably. And it's actually the original decision by the FCA board to do nothing about the SWIFT report that's what got me really engaged in this issue, because I just could not believe the utter wickedness, really, of that decision. Yeah.
Thank you very much indeed. And Mark, I know the answer to this, but others might not. Could you just tell everybody a little bit about your background, please? Thank you.
Long time ago, I worked in the city. I started as a runner, and then a blue button on the stock exchange, and I ended up at Morgan Stanley, trading, the head of trading on their US equity book in Europe and Japan, and then handing it back to New York. And then I left them and went into private equity on my own account. And I met with success and disasters in equal measure. That's about it.
Oh, thank you very much indeed. Thank you. We're going to go to Abhishek. Abhishek, I hope you're stationary in that vehicle. I don't want to hear from you if you're not.
No,
are you stationary?
My wife
Abhishek?
is driving, but apologies
Lovely.
if there's a bad signal event. In sunny Norfolk, well, not Norfolk. Anyway, thank you, Ian and Steve, for that. Just a very quick question for Ian. Ian, to the best of your knowledge, to what extent do all those sort of kind of BAL rules and everything apply to building societies? Because I've been involved in, and I've still got a couple of fairly sizable fixed rate loan type disputes involving building societies, where effectively we're talking about the same thing as the Ulster issue that you're talking about of embedded derivatives.
I would be 99.9% sure that they do apply, actually, because basically the potential rule set does apply to building society. There's obviously some differences around capital and how the capital structure of a building society is different, but the way they calculate their risk-weighted assets is the same. So yes, essentially they are applicable. The rules that I described are applicable to the building society movement. Yeah, but obviously, in terms of the building societies now, which measurement system they use, because most of them wouldn't be big in derivatives, they might end up using quite a simple measurement system, because most of them would have quite modest, but Nationwide may well use internal models, for all I know.
Yeah. Okay. Thank you. Thanks.
Thank you. Abhishek, staying with you if you don't mind, I think you put a note in the chat along the lines of you gave the Swift and his team some information for quite some time. Tell us a bit more, if you could, about what you shared with those guys.
No, it's just a can't even remember now. To be honest with you, it was like 6-7 hours worth almost. It was 1 December, and it was only when Steve was saying that, a number of people would have given him information.
Yeah.
So I definitely spent at least an hour talking about contingent liabilities, because I said, I even actually joked saying, because there's 3 people taking notes in the room and videoing it and transcribing, I said, you guys are going to need to take a little comfort break before we start this session, because this is the elephant in the room. And I've got all this in the transcripts and stuff if we ever need it, to show that this stuff was given to them, and they've accepted it was given to them, because otherwise they wouldn't have produced a transcript. But in terms of what did I give? Nothing particularly different or special to what Steve would have done, what Paul Carlier would have done, etc., etc. I was quoted a bit in the report, though not by contingent liabilities, though, but just the usual stuff. But again, the reason why the contingent liability was so important was because of the quantum, right? Of the consequential losses. And if there was only rerun of the scheme, it would have to do something to take account of those contingent liabilities. Because like Steve was saying, if you're just going to replace a 5-year structured collar with a 5-year interest rate swap, that might make it look like a friendlier, more cuddly product. But in terms of compensation to the client, it's going to mean diddly squat, because the contingent liability is going to be roughly the same anyway. So that doesn't get you to anywhere other than ticking a box. So so I said, it should be a full tear up, for example, or at least a cap where there's no contingent liability, for example. And that's going to lead you to billions of pounds of more redress. And that's why it's not surprising that, someone asked a question to Steve, do they think that, Swift deliberately did this? It's not an accident why he's excluded it. It's not because he couldn't find the 51 references to it. They simply had, in my view, no choice but to exclude anything related to consequential losses relating to contingent liabilities, because then you've literally got these £1 billion numbers we're talking about. And as someone just mentioned, it's also about these businesses that have gone bust, like Angel Interiors is going to be one which you guys will go through now. In 2013, I think it was, I actually hosted a meeting at my offices with 4 people from the FCA, the Insolvency Service, his Treasury, bully banks, a few lawyers, R3 insolvency body, just to discuss one topic, and that is how do we deal with the IRHP review customers who'd already gone insolvent. Now, you may have administrators involved, you may have liquidators, etc., etc. So those billions don't even account those businesses as well. So it's for those reasons that I think the contingent liability is a serious issue, which is why I think it had to be excluded.
Thank you. A one-word answer, if you can, please, Abhishek. Do you think the quantum of losses were so great that they would have registered on the prudential risk concerns? That the balance sheets of the banks, would these potentially have jeopardized the financial stability of any of the banks?
So,
Abhishek's frozen.
I think
Andy,
Yeah.
Andy, sorry. I think what you said was, do I think the number was too big to potentially affect the banking system? Is that what you asked?
Yeah, I was asking, was the potential quantum of loss large enough to be a concern for the balance sheets of the banks by prudential stability?
Yeah, absolutely. I believe it was, and I'll tell you why. This recent chap who, and I don't know if I've publicly told anyone, I don't care anymore. This chap who recently he was going to be he was standing to be the Tory mayor, and then he got in trouble for some allegations of stuff. Daniel Korski, that's it. Right. So at the time, he was, I think this may have been 12 or 13, he was one of the business advisors to David Cameron, the Prime Minister at the time. So I was asked to try to quantify some of this by number 10. And I basically said, I actually don't think I could quantify this because I think the numbers are going to be too big. And the reason is it's not these 10, 15 billion numbers that we just talked about, because I said, if you start to include fixed rate loans, you are talking incredible large numbers, because you've got people like the Co-op Bank, you've got Aviva, you've got Nationwide, all sorts of building societies and lenders who provide fixed rate lending. But you've also got much smaller ticket sizes. So I used to be at Lloyds Bank, for example, and I know Lloyds had a very large agricultural division. I think it was AMC it was called. So they used to provide fixed rate loans for to little farmers and stuff for as little as 50,000-60,000 pounds. But again, they had embedded derivatives in there. So where do you draw the line between the two? And that's kind of why you kind of find there's no accident that there is this lacuna in the law, as it were. When Jonathan Fisher QC and the other QC, the Treasury Select Committee, the FCA one, kind of fought it out and sort of said that these things may look like derivatives, smell like them, and act like them, but technically they're not, and they're not covered by regulations and stuff. But anyway, sorry, you asked me for one answer. Do I think the number was too big? Yes, absolutely, I do.
Thank you very much indeed. I appreciate your contribution tonight has been spectacularly helpful. Thank you very much. I'm coming round to thinking, folks, that in the weird world of banking and the senior people at the FCA and the senior people at the Treasury, I'm wondering if they can sleep at night because they say to themselves, we had to shaft the business owners because if we didn't, the banks would have fallen over and then the economy would have been down the toilet. I wonder if that's how they keep themselves asleep. Ian, don't go there. Ian, don't go there. We're going to go to Anthony Stansfield. I want to leave it hanging. We'll come back to that point later. Mr. Anthony Stansfield, thank you.
Yes, very quickly. I had meetings with Andrew Bailey when he was running the FCA, and we had copious correspondence. He was well aware of what was going on, and he just covered up at every possible opportunity, as I think some of his staff did too. And it may be worth me sending you my correspondence with him, actually, on that subject. I don't think you've seen it. The other one is the Treasury Select Committee. The problem is most MPs don't understand banking. So the people that go on to the Treasury Select Committee are the few that do, and they all have a vested interest in covering it up. And I've been to 2 of their meetings, and all I saw was those who actually understood it, making every effort to cover up. And of course, they're all looking at their jobs when they leave. Many are ex-bankers or very closely associated with banking. So you are not going to get a fair result, in my view, from the Treasury Select Committee, I'm afraid. And I think those who don't have a close interest in banking, of course, don't know enough about the subject to be able to say anything particularly intelligent. So you have rather the Conservative members are the ones who are the ex-bankers, and the Labour ones are not, and they don't really understand it, so they don't stand up. And I'm sorry that 1 or 2 people like Kevin Hollinrake haven't actually stayed on the committee and done a little bit more about it, because they were quite aware of it. Thank you.
And thank you, Anthony. For those of you that are new to the Transparency Task Force and might not know Anthony, Anthony is the former Police Crime Commissioner for Thames Valley, who was instrumental in getting the bad bankers locked up. His force took the case over after 2 others had turned it down. One wonders why. And Anthony was also, I believe, the National Lead for Fraud for the Police Crime Commissioner. That's who you've just heard from. Thank you, Anthony. We're going to go to Mark Bannister, and then we're going to start talking about Angelic. Mark Bannister, as succinctly as you can, please. Thank you.
Very quickly, apropos my other commentary earlier about holding the FCA to account, I'd just like to point out to members that Ashley Alder, the new chairman of the FCA, who admittedly was only appointed in February of this year, so the SWIFT report was accepted before his time. But it's interesting to note that his former job was that of chairman of the Hong Kong Securities and Futures Commission. So if ever there was a man who would understand exactly what we're talking about and margin credit, it's this gentleman, because it was central to everything he did in that role. I might also note that before he was appointed to that role, he was also a former senior partner of Herbert Freehills. Isn't it amazing how the wheels go round and round? So I just think that you might all find that rather interesting. But if we put these boys on the spot, they have nowhere to go, because their own credibility demands that they are honest about this. And as regards what Abhishek said, I couldn't agree more. The reality of this is that it will bring all the banks down. and the government know it. But we've got to have a decision here. Are we going to have corrupt banks, or are we going to have a viable economy? And I suggest that the two cannot be mutually exclusive with one another. So there we are. Thanks.
That's a very thought-provoking set of inputs there, Mark. Thank you very much. I'm going to invite now Ian and Steve to move the subject to focus on Angelic. So, guys, tell us what's the Angelic case all about? Go for it, guys. Thank you.
But just before I do that, I just wanted to say that it's important to remember that for PPI insurance, mis-selling of PPI, UK banks raised total provisions, I think, totaling about £49 billion, of which Lloyd's was the outlier with 20 billion. And the banks survived that. So I'm just saying that I don't think if the number was 20 billion, it would necessarily have brought the banks down, but it obviously wouldn't be good for bank shareholders. And just that was just my contribution on the numbers, shall we say?
Thank you. Thank you.
But yeah, I've got another presentation of just a few slides on Angelic. I'll share my screen again. Yeah, I've kept this really short and simple because because you've already had quite a lot of input from Steve and myself on the technicalities, but I just thought it would be a good way to finish the subject of sort of swaps, derivative mis-selling by actually taking a real example of a company known to us and whose director I think is still on tonight. So firstly, this company was classified as private under COB. The reason I'm using COB rather than COBS was the derivative was executed before November 2007. It was executed on the 27th of June 2007. Historically, the company had tended to purchase out of the money caps as insurance against an unexpected rise in interest rates. So that was a relatively low cost way of buying some insurance against a significant move up in interest rates. Quite a sensible hedging strategy if you were worried about, interest rates peaking. However, and I don't mention the bank too many times, but the bank was Lloyd's. They talked AIL into executing a 20 million collar on the 27th of June 2007. And the ironic thing was to save money, i.e. they wouldn't have to pay premiums for the caps. If they did a collar, they would be less premium involved. So to save money was the reason. We'll come back to that. So just very briefly, what is a collar? An interest rate collar is simply where a customer buys a cap to protect itself against a rise in interest rates above a specific level. So if I buy a cap at 5.5%, I'm effectively going to get paid monies if the rate goes above 5.5%, and I would normally pay a premium for that. But to avoid me paying a premium, the bank says to me, why don't you write me a floor? So you say, I tell you what, if you're going to give me this cap on 5.5%, I'm going to write a floor at, say, 4%. So if rates go below 4%, I'm going to pay you. So that's a collar. Within that range, your rates can move, and above that range, effectively, your rate is meant to be locked in. However, that's true if you've got a loan and a facility for the full amount, but we're going to look at that in more detail in due course. But it's important to realize that writing any form of option is potentially a risky business. You are effectively going short of interest rate volatility at a strike price, and you can very quickly become exposed to that. So this is not something that you should undertake lightly. And I think it's quite interesting to note, given the date, 27th of June 2007, those in the know, including the likes of myself, were well aware that there were certain things not quite right with the financial system. We didn't fully understand the scale and the scope of what was to come. I certainly didn't anyhow. But the first tremors from the ongoing systemic liquidity event were already being felt. There had been some CP conduits that were showing some signs of stress. And then just a few weeks later, the first really, really public event happened, on the 31st of July when two Bear Stearns hedge funds filed for bankruptcy, and within a week or so of that, there were massive palpitations across all the markets, and things really began to hot up, so to speak. So, in a sense, in terms of timing, you couldn't have chosen a worse time possible to be writing a floor or to write any option, to be honest. So, when is a hedge not a hedge? Well, this is an incredible example of when a hedge is not a hedge. The original credit sanction had called for a hedging transaction of 15 million against the facility mark for the company of 20 million. However, on the date that the actual hedge was executed, the amount borrowed by the company was only just over 3 million. And the expiry date on that facility was 3.5 years. So, but the bank managed to talk the company into not doing a 15 million, which is what the credit sanction had asked, not doing 75% of 3 million, which would have been consistent with it, but they talked them into doing 20 million, and actually not for 3.5 years, but for 5 years. What's that about? So let's be clear, you've now got a hedge that is many times bigger and longer than the underlying exposure it's meant to be a hedge of. It isn't a hedge for obvious reasons. You've actually created a massive outright interest rate position, and effectively in technical terms, the customer is now writing an uncovered option. Wow, that's a pretty risky thing to be writing. It's the sort of thing that some of the more, perhaps a hedge fund might do, or some highly sophisticated trading operation. It's not the sort of thing that an SME in the UK that is a completely different business should be doing. So the only explanation that exists for the bank's actions are that by making the collar longer and larger than appropriate, and by selling a collar rather than say out of the money caps, the bank was making many more times day one profit. Basically, if they'd sold caps, say they might have made 50 grand. By writing this collar, by making it longer and larger than it needed to be, they were probably making around 300 or more grand from that transaction. So that's the motivation for the bank to do it. But even if it, to be honest, even if it had been for the right amount and the right expiry date, it's pretty clear to me that it wasn't that great an economic hedge anyhow. The out of the money caps was a far better strategy. The reality was that for the nature of this business, which was a property development business, the most risky event that could happen to a property development business is a sustained economic recession. And in that scenario, interest rates would go down and you would want to benefit from low interest rates. So the only thing you were worried about was a spike in interest rates. And that's why the out of the money caps were sensible. But writing a floor, which actually falling interest rates would have been a good economic hedge to a sustained economic recession. So it fails every single test of being a hedge. It's actually a completely gross example of overhedging. And this is an incredibly brief version of what Steve went through. Its sale was pre-MiFID, so the COB applied rather than COBS. As Steve has already explained, COB 7.9.3.R is absolutely explicit that a bank can't grant credit for a private customer unless the customer has given their prior written consent to both the maximum amount of the loan or credit. That didn't happen. The other thing is that another part of COBS requires the company with a form of notice to basically give them a health warning. It's a bit like cigarettes can damage your health. You basically have to write to them to say derivatives can damage your financial life, and they have to read it and acknowledge receipt of it and send it back to you. Of course, the bank didn't do either of those things. Nothing was sent by the bank. Nothing was returned. The sales leaflet, which I have had a good look at, it sets out 7 benefits to the company of doing a collar and no disadvantages at all from executing it, and so hardly meets any sensible requirements of COB 2.1.3 of clear, fair, and not misleading. in pushing this collar that they executed, which was far more profitable to the bank, it's clear to me that the bank was clearly not acting in accordance with COB 2.2.2 that requires that a firm does not conduct business under arrangements that might give rise to a conflict with its duty to customers. It's absolutely clear that the bank had no concern about its duty to the clients. It was only interested in its own P&L. In summary, a completely non-compliant sales process led entirely by the desire for day one profit. And this ignores any other very real legal issues that arise from the fact that they didn't even bother to get an ISDA master agreement signed. The only thing they ever sent was a trade confirmation 7 weeks after the date the trade was done. And they never asked anybody to even sign that on behalf of the company. So you might begin to question whether there was ever a legal contract in place at all. But that's just, I mean, as I say, you couldn't really make it up how incompetent and poor this whole transaction was. Hidden credit lines, the bank didn't comply. The company was completely ignorant of the additional credit line marked against the company for years. It was only far later in years when they got disclosure of documents that they began to realize that something had gone on. Clearly, interest rates fell rapidly in 2008 and early 2009. So my estimate is the credit line probably peaked in about May 2009 at circa 3.9, which, given the drawn facility it was hedging was still less than 10 million, is a massive add-on to the credit exposure. We have completely separately confirmation from the bank's lawyers that these treasury limits were treated as hard limits and are thus part of the very important LTV covenant ratio, and thus the additional derivative credit line was clearly an important part of the internal justification for moving this company to the, I'm going to use the word specialist, probably I should have put it in inverted commas, business support unit, where the company, along with its sister company, could be more intensively managed for the bank's benefit. So you'd have thought, having missold one derivative, what would you think the bank would like to do next? Well, I tell you what they did was they decided to grossly missell a second one. So in October, well, on the 1st of October, what they did was they rolled the remaining period of the existing 20 million collar into a new £40 million interest rate swap. This was executed on the 1st of October. If anything, this is actually an even worse economic hedge than the first one, because the swap is now for 5 years. They've asked the company to execute a 5-year swap, whereas the two facilities in place, which don't total 40 million, they only total 29 million, are for 15 months and 4 months to expiry. So again, completely inappropriate over hedging, completely unjustifiable. All it really does, I think, and that's why I've kept this fairly short and simple, is it just illustrates the greed of the bank, as the sole driver is to take another large payday from the new sale, as well as I guess the other thing it illustrates is the complete power and knowledge asymmetry between the bank and its client. I won't bore you now by detailing all the sales process failures or the legal document failures and weaknesses, but they certainly don't paint the bank in a positive light. And I guess where I finish, it's a bit like what Matt said, is, to my mind, justice demands recompense for these two very damaging derivatives. And to think that the FSA classified AIL as sophisticated due solely to the size of the interest rate collar. And now this is where I suddenly got this, it got me thinking. But interestingly, if AIL had actually been sophisticated, it would never have agreed to execute the damaging collar in the first place, and thus it would have remained unsophisticated. I hope you understand my logic. So yeah, right. That is, I kept that short and sharp because I didn't think it was necessarily helpful for everybody to spend too much time, but give you the flavor. And I know there are other people on this call that have similar examples of derivatives that were missold. I'd be surprised if there are many that are worse, but because that really does tick nearly all the boxes. Yeah, I'm finished.
Ian, thank you so much. Thank you so much to you and to Steve. Before we go to Ian Lightbody, then to Trevor, then to anybody else who wants to make a question or sorry, make a point or ask a question, can we please all show our appreciation to our speakers tonight? I can honestly tell you, I do quite a few presentations. What they've gone through tonight would have taken hours and hours and hours, if not days, to prepare, because they had to make sure it's factually correct. They had to be precise with their language. That's not like knock it up on the back of the fag packet stuff, folks. That's been really, really quite high, very high quality input. So, Mr. Steve Middleton, Mr. Ian Tyler, we're all extremely, extremely grateful to you for what you've shared with us tonight. Thank you very, very much indeed. Thank you. Well done, guys. Very, very well done. Thank you. I'm sure folks may want to put some nice comments in the chat to show their appreciation further. We're going to go to Mr. Ian Lightbody, who I'm so pleased is with us tonight. Mr. Lightbody, very, very good to see you, sir. Please share your thoughts. Thank you.
Okay. Andy, good night. Good evening to you. Can you hear me okay, everybody?
Perfectly well, yes, we can.
Sorry, I'm on my phone. Firstly, thanks again. I reiterate what you've just said to Ian Tyler, who's fairly new to the scene, Steve Middleton and Anthony Stansfield, who are absolute veterans of this problem. A lot of the stuff that you've brought tonight has been well known to us all, but some new stuff as well, which is fantastic. My point of interest is not surprisingly or unsurprisingly is Clydesdale Bank. And I think if you look at RBS with GRG and Lloyds with their business support unit and CYBG are exactly the same, they were all profit centres. These people were basically taking, you've heard it tonight, people never missed a payment, good customers, and they were gamed. And that's my point tonight. We've all been gamed. So if you look at Abhishek, you look at Julia Davey tonight, you look at Mark Bannister, you look at Ian, even Ian Tyler. We are all being gamed, and we have been gamed. So it's a case of now, where do we go from here? The couple of things that have come out tonight, matters arising, I would call them, from this. COBS, for instance, COBS, as you mentioned, I have written evidence and actually taped evidence of the Clydesdale Bank's high-ranking management basically badgering the Financial Ombudsman Service not to mention COBS in relation to fixed-rate loans because they were unregulated. So COBS, they were suggesting COBS, whereas if you go to the Treasury Select Committee, they basically admitted that if it was a fixed-rate loan and it was an IRHP, which we were purported to be getting, if it was an elephant, if an elephant spurts water and runs like an elephant and jogs like an elephant, it's invariably an elephant. So again, Steve will know more about this, but the fact that we've got these fixed rate loans which were basically tailored to get or to circumnavigate regulation, and they were paranoid about bringing COBS into it. The next thing I'm going to hear, you're absolutely right, Andrew Bailey, who I'm still, believe it or not, still in contact with, which you'll probably be interested in, Treasury Select Committee. It's just platitudes. It's always been platitudes with them. They basically, they'll tell you what you want to hear. They'll tell whatever audience you want to hear what they want to hear, and then nothing's achieved from it. SWIFT was the same. We believe, as with Abhishek, as with Paul Carley, with Steve Middleton, we put all our concerns through one medium, a consequential law specialist, and we didn't want to overburden them. Moncton Chambers, so for instance, we have an opinion from Moncton Chambers, which is Swift Chambers, saying that Clydesdale Bank defrauded us. So the same Chambers, Moncton, wrote back to us and saying, yes, thank you very much for your initial approach. We will be back in touch. Nothing. Nada. Same as Steve, same as Paul Carley, same as Abhishek. Abhishek was in there for hours. So Swift, again, there's another, Swift replied, the FCA replied to Swift in 24 hours. This was a report that had been going on from, I think, April, and it was published in December. I think it was 21. Can't remember. I'm the same as everybody else. Can't remember. It's too many, but if you look at, I'm interested that Ian Tyler, for instance, mentions the PPI scandal. 53 billion it was, Ian, over the UK.
I only Googled it. I apologise.
You're wrong, Ian. Here's you. You're the money man, and I'm a builder. It was 53 billion, and Clydesdale paid out 2.3 billion, which is over 4% of the market share. They only have 2% of the banking share, but Clydesdale Bank paid out more on PPI than the whole nation paid out on IRHPs. And it was obviously, we were gamed, and it was meant to happen. So again, the fixed rate loans, I'd like to bring the fixed rate loans in. Abhishek Sanchev is absolutely bang on the money here with these. It's in the chat. Basically, if they bring fixed rate loans in, it's an absolute, it's billions, it's tens of billions. It's not 15 billion, it's not 10 billion, it's 10. This is bigger than PPI as far as I can see from my experience of being around. So again, all I would say is the FOS, the FCA, the CPS, action fraud, judiciary, and the judiciary, especially in Scotland, is so basically institutionally led. It's a scandal. The BBRS, we've all seen this. We've all tried our utmost to make it work. What a scandal that was. And I'm ashamed to say that I met with Lewis Shan-Smith a number of times. The only thing I would say, to give myself any kind of get out of jail on this one is I basically knocked him back and said I didn't think they were fair and independent back in 2019. One thing I think you should all be interested in is the recent CMC. We're going to court with Clydesdale in a month's time, 2nd of October, 12-week trial. The Justice Zaccaroli is a judge. He was the guy who did the plagiarism case with Ed Sheeran. I'm hopeful that he hasn't been nobbled or won't be changed. Just to let you know, back in March, in the last CMC, which was obviously the case management conference before going to court, there's been a couple of hearings since, but this has all been procedural. The bank changed their defences to say that they did add margin to our loans, covert margin. But what they said was it was called additional income element. So it wasn't on the margin side of the loan, it was on the other side of the loan. So basically what they did was they purported these loans to be LIBOR based, but they were actually a swap, 10-year swap rate. So they added roughly 0.5% to each loan, which they've now admitted. What they said was, and their excuse is, and I've got the transcript, so I'm happy to share it with the TTF and everybody who's here tonight. The transcript from March this year said was, all the banks were doing it. To which my response was at that point, being in the court, was that's like the Clay twins saying that Ronnie Biggs robbed a train. We're going to do it and we'll get away with it because Ronnie Biggs got away with it too. Thankfully, the judge basically came back in. He went out to consider, came back in and said that the problem is not the fact that you did it. The problem is the fact that you didn't tell anyone you were doing it. You did it covertly, and that absolutely contravenes Consumer Credit Act, amongst others, which is an unfair relationship. So all I would say to you that going forward now is that I think the only way now is to get this resolved is through the courts. And we're, as Clydesdale, we're going obviously after them in October. 1,000 businesses, SMEs representing 1,500 loans. That could be a really, hopefully, that could be a really groundbreaking case. And also the judicial review for judicial review, which obviously yourselves have been involved with. We've all been involved with regards to Housefelts, and I think we've just got to somehow break through the courts and make I think possibly, unfortunately for Anthony Stansfield and others amongst us, that we need a change of government. We need a new government as well, because this government is just an absolute scandal. We've all been around for 6, 7, 10, whatever years, and nothing's happened. John Glenn's an absolute shambles. So that I'll leave it. That's sorry, that probably went on too long, but it's such an interesting debate, and I haven't been around it for a while, and I hope that adds a wee bit of value.
Ian, what you've said tonight's been spectacular, and we've missed you. I'm going to organise Chelsea to get a conversation going. Me, you, Ian, Steve, maybe one or two others, because we need to get right up to speed with what each other's doing. Because what you just set out is absolutely spectacular, folks. Can I please invite you to put your hands together to thank Ian for what he's just explained, because there's some absolute gold dust within that. So, Ian, whether you like it or not, I'm coming after you for a conversation. Thanks very much.
Can I share one more thing with you? On the way back in March, from on a train from my flight was cancelled, so I took the train back, and I thought I'm still, I said to you before, unlike others who I think has met, Anthony said he met Andrew Bailey. I actually met him 4 times, and let's say I keep, every time I came out, I checked my watch was still on my wrist when I shook his hand, but I'm still in contact with him. And there's one, and I think it's sometimes you've got to keep some of these people close to you. But, and as I've said so far, it's all about platitudes. Anyway, I messaged him to tell him what happened in the court case, and he messaged me back that night, which he's prone to do. and he said, Ian, I don't know what astounds me more. One, they said they did it, or two, that they said that every other bank did it. So I, somewhere in there, I think if we keep pushing and getting a concerted effort together through the courts, through what all you're doing, we will we'll get there eventually. Yeah.
Fantastic, Ian. Absolutely fantastic. Now, your thought about taking to the court, I think, might tie up with what Trevor's about to say. Mr. Trevor Mealam, over to you, sir. Please be as succinct as you can, Trevor, but be as hard-hitting as you want to be. Go for it.
Hi, Andy. So this is for Steve and Ian Tyler. 3 lines of defence. 3 lines of defence are the risk governance framework that splits the responsibility for the operational risk management across 3 functions. Nigel Harper may also have comments on this. Individuals for the first line and manage risks directly. The second line oversees the first line, setting the policies, defining risk tolerances and ensuring they are met. Third line constituting the internal audit, provides independent assurance of the first 2 lines. Now, this was codified by Basel Committee, Banking Supervision, 2011, the Principles of Sound Management of Operational Risk. So laying that down as a framework, what I'd like Steve and Ian perhaps to come back on, we know from Anthony that with HBOS Reading, there was stages 1 to 4, but there weren't stages, I believe, 5 to 8. So therefore, with people like James Crosby, who flit between the FSA, the banking and the Parliamentary Commission on Banking, the real question is to Steve and Ian, who do we blame? Who is responsible in these banks, these swaps, in the 3 line of defence? Who's got away with it? Who are the natural persons that we should be pursuing for Lloyds BSU, RBS GRG, for the deception?
My view on that, Trevor, is nearly all the banks' downfall across the economy stemmed from the markets areas. So it's a difficult one because RBS were trying to become the biggest bank, and that was under Goodwin. He just drove them to do whatever they had to do to increase the size of the bank and turned a blind eye, I think, to virtually everything. So Goodwin, to me, is very much in that criminal element in terms of what he would have allowed to go on in the bank as long as he got where he wanted to be. But the real issues were perpetrated via the markets teams, and it was the markets team who raised the money for the banks effectively. So RBS markets were losing money, substantial amounts of money for a long time before, and it goes back to this: is it Bear Stearns, these type laws in the US of having your investment firm, treasury firm, mixed with your bank, because they're losing the money and they're drawing all the funds from the cash and from the investors. So I think it splits across 3. I think it goes to the executive at the bank. I think it's very much focused on very bad behaviours in the markets areas across all the banks, which is sales side of things. But I also then think you've got to go to the risk committees in the banks, because they're the ones who report to the regulator. As far as the regulator is concerned, I mean, we have different views on this, I think, to a degree, but I'm so much of the opinion these days that the regulator is just the Treasury's tool for protecting the banks from the repercussions of these behaviours. Yeah, but I think you've got to start. You've got to start with the banks. I think that the FCA are a tool of the banks rather than the other way around, obviously.
I think one of the main findings from because there were detailed reviews done into the failings, particularly of RBS and Lloyds, and they spent many millions investigating the failings, and they even did, actually, to be fair, I think they did even look in some detail at individuals, but there were, to the best of my knowledge, there were only ever 2 people that lost their jobs over the failings, and that one was Fred Goodwin, who lost his knighthood as well, and the other one was Johnny Cameron, who was the head of the corporate and the investment bank at RBS. But everybody else kept their jobs, and part of the problem was, of course, was that nearly everybody else was able to sort of hide behind corporate decision making. And so that's why the SMCR came in, because actually now, if you were to be given access to the SMCR, you would actually find that named individuals have areas of responsibility and things. So it would be far harder in a rerun for the individuals that were the decision makers to deny responsibility, because they now actually have individual responsibility rather than corporate. It's the classic case, really, of people hiding behind corporate decision making and saying, look, we made this decision as a board, we made this decision as a committee, and so nobody's to blame. That's been the problem.
But Ian and Steve, shouldn't we be looking at when you go to court, you will get some low down manager, and when you ask them questions and you cross-examine them, as I've done, they will often say, I don't know the answers to that. Is there not some argument that under risk and compliance and 3 lines of defence, shouldn't some of these higher people now be held to account?
But the ducky Trevor, it's like normally when we're doing some work on the Perks case, we actually got a GRG director in there, Neil Graham. He was a senior director. Ian Fraser's written about him previously. And but they put him in thinking that he was going to be quite innocuous and just talk about how wonderful GRG was. But when we got him to admit about the swaps and credit lines and everything, that was all overturned by the barrister, in the room with the judge, But what they normally do, the bank fill the room with the people who can't answer the questions. Yeah. So if it's a swap issue, they won't want anybody in there from the markets team unless they absolutely have to. They'll often put somebody other than the manager up there. So when you're talking about credit lines and other issues, these people don't know the answers to the questions. I've seen it time and time again. But I'm not sure. To me, that's a bigger question. That's the judiciary and the banks and the whole legal process that they've spent years grooming so they can get away with these things. They've been buying their results and precedents in the courts for years now, in a very slick system of creating their own laws effectively. I think that's almost kind of a different argument. I think if you're back to where did the problem stem from, and you certainly had people, a rotten core at a high level that has never been addressed.
Yeah.
It's a fantastic conversation, folks. We're going to go to anybody other than Ian and Steve for any final comments that you're itching to make before we start bringing things to close. And then what I'm going to do is go to Mr. Ian Tyler for any final thoughts from Ian Tyler, and then to Steve Middleton for any final thoughts from Steve Middleton. So does anybody else want to come in for a brief comment before we go to the final stages? Please raise your hand digitally if you can, otherwise I might not see you. It looks like we're all good. We've seriously run. Oh, forgive me. I can see Julia waving a hand. Julia, yeah?
Hi. I wanted to say thank you guys for tonight, especially Ian and Steve, because I know, as Andy said, it took an awful lot of hard work. So much appreciated to you.
You come in now.
Thanks, Julia. Thank you for your thanks for Ian and for Steve and for
everybody
else.
And everybody else, of course, yeah.
Thank you very, very, very much. Nice to hear those kind comments. Does anybody else have anything before we start going to a close? My instincts are telling me to go to Nicholas Wilson. I always follow my instincts and my urges. Mr. Nicholas Wilson, there's something at the front of your mind, sir. I don't know what it is, but please share it. Whatever it is that's at the front of your mind, Mr. Nicholas Wilson, please now share it. Thank you.
How dare you? I've had trouble keeping up with it all. There's nothing in the front of my mind, just confusion, really.
Okay.
I mean, it might be an opportunity for me or for you to say that, as this is recorded, and as it might be the case that somebody might want to make a short film, whether anybody would object to being in the film.
Well, everyone's recorded anyway, and we can repurpose the film as we wish. So that's no problem at all, because that's absolutely fine. That's all good. And I do hope you find some nuggets amongst this lot.
Oh, yeah.
There are several.
I'll have to rewatch it all, but it's invaluable. I mean, we're the only people. Well, you guys are the only people doing this. It's unbelievable. That's incredible.
It's all coming out in the end, isn't it? Thank you very much indeed, Nicholas. Thank you. All right. So, Mr. Ian Tyler, your final thoughts, please, sir. Thank you.
I'll just say one more thing, which is it links into all these letters that the FCA sent out to people who complained about the Swift review, and you get these really detailed letters which and in the end you get the FCA, who in theory, well, not in theory, I mean, they are appointed by government to be the regulator to police these rules. That's their job. They are the regulator. They're meant to be the upholder of the rules. And as I think Steve and I have actually demonstrated, some of these rules are very clear. The man on the Clapham omnibus can understand what they meant to mean. And yet you can get a letter from our regulator, whose job it is to uphold those rules, that actually says something that's completely contradictory to the rules. And that's because they hide behind, say, a judgment made by a judge who also was misled. So you end up, it's like Alice in Wonderland by the time you get to that. It's, you know, and I mean, that's it. That's what I want to say.
And we get it. You put that very well.
It's like Alice in Wonderland. That's how it feels sometimes.
Thank you, Mr. Tyler. Wonderful. Mr. Steve Middleton, apart from my very final thoughts, you have the last word, sir. What else would you like to add to the brilliant stuff you've shared with us so far tonight? Thank you.
Well, it was Julia who organised a lot of this, so thanks, Julia. It should have been far more about her case, but because certain things are going through the courts at the moment, we had to kind of curtail and limit what we could talk about in terms of Julia's case. But you'll see in her position that the mis-selling was entirely egregious, and the fact that it makes me laugh when they made these products a condition of lending. You know, a condition of lending. We've never learned anything, have we? Go back to the endowment mis-selling. Oh yes, we've checked with the risk committee, and you can have the mortgage, but only if you buy the endowment at the same time, because of the big commission on the endowment that nobody disclosed.
Yeah.
It's like we've learned nothing. You know, and it was one thing I put in my presentation, I didn't actually say it, but to me, this swaps issue was just endowment mis-selling on steroids. That's what it was. We're just doing the same things, mis-selling to the same people, and the record is a broken record, and it's got to be stopped. Yeah, we can't continue mis-selling to consumers in this country as a way for the banks to make their living.
Well said, Steve. That's beautiful, Steve. You're absolutely right. I remember the endowment mis-selling days very, very well. Two fundamental flaws. Firstly, the company or the sales guy didn't properly disclose the motivation, i.e., if you buy this product, I'll get much more money, please buy it. And secondly, I'm not going to properly explain to you the possibility that if markets don't go as hoped for, there's a real chance that you won't pay off your house. So lack of disclosure or transparency on the motivations, and lack of disclosure or transparency on the risks. Sunlight, once again, folks, is proving to be the very best disinfectant. We've all put in some extra time tonight, folks. It's 8:15. I've gone over by hours and hours and hours and hours. Sorry about that. I've mismanaged everything. I always do, by the way. If you're new to TTF, just get used to it. But the content tonight has just been absolutely gold dust. And I reckon there's maybe 4 or 5 or 6 new pieces of information that are really rock solid that we're going to make damn good use of. And I'm pretty sure Mr. Nicholas Wilson is going to home in on them for his explainer videos. Fantastic work tonight, folks. Everybody, thank you. Please do put your hands together and let's all applaud ourselves for the effort and the ongoing determination to get the truth out into the open. Ian and Steve, particularly good job, guys. Thank you all. Good night. Thank you very, very much indeed.